The weighted average cost of capital, or WACC, represents a firm's average cost of capital from all sources, including common stocks, preferred stocks, bank loans, bonds, and other forms of debt or equity securities. Let me explain the components of WACC formula. So in WACC here you can identify two different sources of financing: D, debt, bank loans; E, equity. Okay? So the idea is to calculate the weights, the share or part of the debt within the total financing V. V is equal to what? The total value of component securities. In this case you have two sources of financing: debt plus equity. So V is equal to debt plus equity. Okay, so you calculate the first weight, debt divided by the V, total sources of financing, and E, it's equity divided by total value of financing. So you have two weights, all together will give you 100% of the financing. So this is what we call market weights of debt and equity in the total market value of the firm. Then the cost of debt, it is T is cost, R debt is cost of your debts. 1 minus T is the cost of debt after taxation. So you have to consider the taxation, profit tax. Why? Because the interest on the debt, like coupons or interest on bank loans, are tax deductible costs. If you have such interest, this is treated or booked as a cost in P&L, and you pay less profit tax. Because of that effect, you have to consider tax shield. So 1 less T profit tax rate in the country where you are based. In the case of the shareholders, you just multiply the weight of your equity in total financing times the cost of your shares. So this is of the cost of the shareholders' equity. You can notice here that there is no tax shield, there is no times 1 less T, because the dividends do not impact the profit tax. I mean, the dividends are paid after net income, after you have paid profit tax. Whether you pay more or less dividends, you will pay the same amount of the profit tax in your country. This is why we do not reduce the cost of the shareholders for the amount of the profit tax. Speaking about the cost of debt, in case of the bond, we speak about the yield to maturity, okay, that I have explained in the lecture when we spoke about the bonds. And in the case of the bank loans, this is just the interest rates.